Very good afternoon and welcome to the market segment. Asian market participants showed signs of risk aversion today as all the major indexes that we cover fell by significant margins. Investors are said to be steering well clear of risky assets. This as they digest developments taking place in the Middle East and the uncertainty that comes with it. The Nikkei share average declined by 1.02%. The Hang Seng Index fell by basically 2%, while the Shanghai Composite Index closed 0.8% in the red. U.S. markets were subdued at yesterday's close. This after the U.S. Federal Reserve decided to keep rates unchanged at 4.25 to 4.5% for a fourth straight meeting. This was in line with market expectations in any event. The geopolitical risks are said to have been the main drivers of the lackluster performance of U.S. stocks on the day. And today they'll be closed for their Juneteenth holiday. The Dow Jones Industrial Average ended down 0.1%. The S&P 500 lost 0.03%. While the Nasdaq Composite Index closed up 0.13%. Looking at local indicators, we see that currently following global trend, the all-share index is down 0.5% at 94,490 index points. The rand is trading at 18.04 against the US dollar, 20.71 vis-a-vis the euro and 24.24 against the British pound. On the commodities front, we see that gold is trading at $3,373 an ounce, platinum at $1,291 an ounce, while Brent crude oil is trading at $76.97 a barrel. All right, let's get into it now with Simphiwe Letlojane. He's an investment strategist at Absa Investments. Thanks very much for joining us, Simphiwe. So the Fed chair, Jerome Powell, he seems to indicate that there's still a prospect of 2 further rate cuts this year, but opted not to cut interest rates yesterday. And that's despite concerns that there is potentially higher inflation on the horizon.
Yes, decision was largely expected. Markets were penciling in, if you're looking at Reuters poll, that there wasn't going to be any cut in interest rates. That's largely because the Fed has been quite clear in terms of their guidance and some of the rationale for why they are choosing to go with this cautious approach, and really concerns around the impact of tariffs. And they did highlight this quite a bit in their discussion. And then, of course, now we are also seeing some developments in the Middle East. So speaking to a bit of unpredictability as well from a global oil price perspective.
So speaking of the Middle East, we've been hearing a lot about the oil price. We've been talking about the oil price. But one of the issues that's been discussed is the Strait of Hormuz, a strip of water that ships or oil tankers go through. And there's a concern that that might be closed. Can you tell us a little bit about that, why it's important and its strategic importance in terms of the global economy and how it could impact markets if it were to be closed?
Definitely very, very important pathway in terms of, overall just global oil supply and the movement of oil across the globe. It accounts for close to about 20% of, all the global oil production that is consumed. It essentially passes through that particular strip. So very, very important strip from that perspective. It definitely would pose quite a lot of risks if we were to see, disruptions, major disruptions from that perspective, as essentially all pathways will need to be rerouted. And one of the areas where it could actually be rerouted to is, in fact, here in South Africa, the Cape of Good Hope, and we may be benefactors from that perspective. But of course, that's if we also try and fix some of our logistical challenges. But at the moment, the risks are not necessarily too high because there is U.S. presence from a military perspective in the region, and there are some other possible pathways where you're seeing pipelines that run quite close to that area that could also potentially transport goods. But I think the most important one is just U.S. presence from a military perspective, and also just globally, the importance of it means that all parties will make sure that, it doesn't get to that particular point.
Yeah. So oil prices are up around, $10 more than they were last week. In the meantime, the local currency has depreciated after having had quite a good run. This spells inflation. What are your thoughts about short-term inflation?
Yeah, definitely does, pose a bit of a risk from an inflationary point of view. And if we're looking at some of the recent prints that we have been seeing that have been, coming in close to the lower point target, so around the 3% level, the real key driver of that has been the fact that fuel prices have been deflationary. In other words, fuel prices this year have been considerably lower than they were last year. So with this uptick in global oil prices, it does tend to then potentially dampen that outlook. And then, of course, even the prices last year from a base effect perspective are beginning to come down. So then definitely we can see fuel prices coming out of that deflationary territory. If you strip away fuel prices and in fact also food prices and you look at core inflation, that's still very subdued, around 3%. So speaking to still fairly muted demand propensities and the fact that a lot of the inflation that we do experience is largely due to import inflation, currency-induced inflation. And so if the rand and, global oil prices are volatile, then it definitely will spur a bit of inflation locally.
All right, Simphiwe, thank you so much for your time. As always, that was Simphiwe Letlojane. He's an investment strategist at Absa Investments. After a short break, of course, we will likely be going to the weather or to Juliet, but we'll see. And of course, at the top of the hour, Mfundo will have more news for you.